This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're still looking at the first chapter on foreign exchange risk management. I said there were a lot of lectures here. There's a lot in this chapter. But this is the third one on futures. So hopefully I've explained how they work. I showed you in the last lecture the what you might call the practical problems which happen in exams. But now one extra problem, which is to do with how we can estimate ourselves what the futures price will be. Look at example 10. On the 1st of July, the spot rate, this is a little extract, we'll put it all together in the next example, but in example 10, the spot rate on the 1st of July is 1.5050 to 1.5150. And on the same date, we've got September futures, and they're quoted at 1.4900. Now, although you can buy or you can sell futures, there's only sort of one rate quoted each day, regardless of whether you're buying or selling. So you'd either buy at 1.49 or you could sell at 1.49. Maybe we've got a transaction which is going to happen on the 31st of August. And the question has told us that the spot will have changed to 1.5250 to 1.5370. So the spot rate will have gone up, and of course the September futures price will have gone up as well. But they haven't told us the September futures price. We're asked to estimate it. Well, although the two things I keep saying are different, spot and futures prices are not the same thing, but they will move up and down together. As spot goes up, futures will go up and vice versa. We assume always, and I'm about to illustrate how we apply this, but we assume that the difference between the spot and the futures prices falls linearly to zero over the life of the future. Now, rather than keep talking about that in words, let me show you exactly what I mean. As of today, the 1st of July, we know what the spot rate is and we know what the futures price is. Now, the spot rate, there are two quotes, obviously. The futures price is only the one figure. And so, for these purposes, we compare the average spot today with the futures price today. The average spot we call the mid-market spot. And the average, we just add them up and divide by 2. So as of today, it's 1.5050, add them up, 1.5150, divided by 2. The average spot rate today is 1.5100. We know what the futures price is today, the September futures. At 1.49. Now, I say I don't know how many times. They're not the same thing. They will be different. It's just they move together. But as of today, the difference is 0.0200. That difference, incidentally, we call the basis. Now, I said we assume this basis, the difference, falls to 0 over the life of the future. Now, what I mean by that is that these are September futures. They finish at the end of last day of September. So on the 30th of September, although I've no idea, obviously, what the spot rate or the futures price will be, on that day, they must be equal. I mean, that's actually very logical. If you were to buy a future on the last day, you'd immediately have to convert at spot. So on the last day of the future, that difference must be 0. Over the period, though, it'll fall from 0.2 down to 0, and we assume it falls linearly. And so I want to know, or I need to know, on the date of the transaction, 31st of August, what would the difference be? Well, from July to September, change colour. From July to September is how long? July, August, September. So from beginning of July to end of September is 3 months. We're looking at 31st of August, and from the 31st of August to the end of September, 31st of August, end of August to end of September is 1 month. Well, we assume that difference is falling by 1/3 each month, that it's falling linearly. And so the difference on the 31st of August, that difference will have fallen, sorry, it's falling to 0 over 3 months. It will have fallen by 2 months. There'll only be 1 month difference left. And so it'll be 1/3 of 0.0200. 0.0200 divided by 3 is 0.0067. We work to 4 places normally because exchange rates are quoted to 4 places. So that's our estimate of the difference on the 31st of August, our transaction. On 31st of August, we know what the spot is, but again, use the mid-market spot. So the mid-market, 1.5250 plus 1.5370 divided by 2. $1.5310. And so we can now estimate the September futures price. September's future, on the 1st of July, the futures price was lower than the spot rate by 0.02. On 31st of August, it'll be lower than the spot rate, but by 0.0067. So 1.5310 minus 0.0067 is 1.5243. It's just the missing figure. So there is our estimate of the futures price on 31st of August. Now, just 2 things there. First of all, although the difference will fall to 0 over the life of the future, it will. In real life, it doesn't have to fall linearly. So we assume linearity. But, as I say, it doesn't have to fall linearly in real life. Always in exams assume it's linear. And so, in actual fact, in real life, the futures price may be a little bit different. We call that basis risk. So it's not a numbers problem for you, this basis risk. Just be prepared to mention that for the numbers it's 15243 and you carry on accordingly, but be prepared to mention that in real life it might not be 1.5243, it may be slightly different. Secondly, futures prices. Here, the futures price is lower than the spot. Well, it'll always be lower than the spot then. It could have been known that futures price at the moment is higher than spot. Well, in that case, it would always be higher. So if it's currently lower, it stays lower. If it's currently higher, it stays higher. That's not a problem. Better mention as well, you may see in some answers that in doing this exercise, instead of comparing September futures with the mid-market spot rate, they compare just with one of the spot rates depending on whether the transaction is buying or selling dollars. You know, if you were selling dollars, you'd have used spot of 1.5150 for conversion. And therefore they do this comparing with the 1.5150 spot. Now, strictly that's wrong, but it's a minor point. But because there's only one futures price, you should compare with the mid-market. And so if the answer's compared with something else and done it slightly different, got a slightly different answer, that doesn't matter, you wouldn't lose marks. All right. So, having done that, let's do another fuller example with that in it. Example 11. Now, if you feel confident about what I've done so far, then as I've said in some previous lectures, if you feel confident with what I've done so far, pause this lecture, have a look at example 11 by yourself, and then come back and start the lecture again and check with me. You know, it's a much better way of learning to do it yourself and then check and learn from mistakes. Otherwise, well, I will assume that you stopped and had a go yourself. And now you can check with me. Example 11. Today is the 20th of June 2004. S owes a supplier 500,000 payable on 12th of September. And again, we're in the UK, we work in pounds. We know today's spot rate, 4821, 4896, no direct relevance because we're not going to convert today. We know the futures prices today. There's June, September, December available with those prices. They've told us on the 12th of September, when the transaction occurs, they've told us what the spot rate is going to be. But of course, they haven't told us the futures price. And we asked to show the outcome of using a futures hedge. So just like the example in the previous lecture, but we're going to have to calculate the futures price. Do it step by step with me. First of all, what will happen today? As of today, 20th of June, we'll leave the transaction at risk. But we'll start a futures deal. And what's the deal going to be? You know, which futures are we going to deal in? Are we going to buy or sell? Whatever. What are we going to tell the dealer when we ring up? Well, make sure these things stand out in your answer, that it's clear for the marker. First of all, which futures are we going to use? Well, the transaction's on the 12th of September. We'll finish the deal, therefore, on 12th of September. We want the first future after that date. June's no good, it must finish at the end of June. But the first one, the one we'll go for, is September. They must finish by the end of September. We're going to finish on the 12th. No problem. Next, are we going to buy or sell futures? Well, I said I'd give you a rule rather, you can think of it logically, remember, when you're converting, because we're converting dollars to pounds, we'll divide, but we're paying dollars, so it'll be the buy rate 14821. And what worries us is the lower the exchange rate, the more we'd end up paying. Well, rather than have to think that through logically and end up making a mistake, you always buy or sell futures depending on whether the transaction involves buying or selling the contract currency. What I mean by the contract currency, the contract size, they always quote a currency. So the contract size is 62,500 and it's pounds. And so you ask yourself, is the transaction itself, does it involve us having to buy pounds or sell pounds? Well, we're in the UK, we owe dollars, so we'll have to buy dollars. And if you're buying dollars, you're selling pounds. And therefore, we will sell futures. Contract currency is pounds. Is the transaction buying pounds or selling pounds? If it's buying pounds, you buy futures. If it's selling pounds, you sell futures. But here we are going to sell. And finally, remember, we need to know how many contracts we want to gamble on $500,000. But it's got to be in fixed size contracts, which are quoted in pounds. So $500,000, first of all, convert to pounds at the futures price. So we're using September futures, which are 1.4840. The futures price, September. And I won't show my workings, it's wasting time. That would give us the pounds we want to gamble on, but they have to be in contracts of 62,500. So how many does it come to? $500,000 divided by 1.4840 is equivalent to £336,972. Divide by contract size, I get 5.39 contracts. And as I said before, round to the nearest number, whole number, we'll actually deal in 5 contracts. And so we'll ring the dealer and we'll say, sell 5 September futures. At whatever the price is, September futures at 1.4840. I hope that's clear. And in fact, certainly in older exams, there were some questions which that's all they asked for. Not for that many marks, obviously. But it stopped there. It said, what will the futures deal be? Well, there it is. However, more likely, and certainly in this example, we're going to follow it through and see what actually happens on the date of the transaction. So the transaction is on the 12th of September. And 2 things happen, 2 completely separate things. First of all, we convert the transaction at spot. It's $500,000. we're buying dollars, and so the relevant rate is 1.4791, and so we'll actually have to pay $338,043. So no problem there. We'll look back later. Well, I'm not worried actually. Whether we made a gain or a loss, I don't care. Here, in fact, it's moved against us. We're ending up paying more than we would have done had we done it today. However, we also need to know the profit or loss on the futures. And of course, we can't do that until we know what the futures price will be on the 12th of September. And so I'm going to have to leave a gap, and let's calculate or estimate futures price on 12th September. Exactly as I did before, but obviously with different figures. As of today, 20th of June, we know the prices. The mid-market spot, 1.4821 plus 1.4896 divided by 2. The mid-market spot today, 1.4821 plus 1.4896. 1.4821 plus 1.4896 divided by 2. 1.485. Well, I get 85. I'll round it up to 9. What's the September futures price on the 20th of June? September futures 1.4840. So the difference, the basis, 0.0019. The futures end, the end of the future, that's a lovely phrase, but the futures mature at the end of September. And so although I don't know what the two prices will be, and I don't care, the basis, the difference, will be 0. It falls linearly over the period, we assume that, and I want to know what they'll be on the 12th of September. Well, in the last one, it was ends of months or beginnings of months, so it was whole months. Here, really, you'll have to work in days. So from June to September, well, 30th of June, there's 10 days in June. There's the whole of August, September, April, June, 31 days in August, and then there's 12 days in September. Oh, sorry, to the end of September, I beg your pardon. 31 days in August, 30 days in September. So from now till the end of the future, there's a total of 71 days. From the 12th of September to the 30th of September is 18 days. So what will happen to the basis? On the assumption it falls linearly, it'll have fallen to 18 divided by 71 times 0.0019. How stupid of me. Sorry, I missed out a month. I bet you were sat there thinking how stupid. Anyway, sorry. From June to September, June has 30 days, so there's 10 days in June. I forgot July. So we've got the whole of July. July is 3rd September, 31 days. We've got the whole of August. That's 31 days. And then we've got 30 days in September. So in total, 61, 91. I'm scared now. 102 days. So the 102 days to expiry at the moment. On the 12th of September, the date of transaction will be 18 days. And so now, hopefully, I can get it right. The basis, the unexpired basis on 12th of September, there'll be 18 over 102 times 0.0019, which comes to 4 decimal places, 0.0003. Now, don't worry about the old day. I mean, it makes hardly any difference. Sorry, missing out a whole month did make a difference, but otherwise, you're not going to be marked down because you had 30 days in August when it actually were 31. Irrelevant. However, now we're there, are we not? Because we know what the spot rate is on 12th of September, so the mid-market price is the average, 1.4791, plus 1.4812 over 2. So the mid-market, 1.4791 plus 1.4812 is 1.4802. Adjust it by the basis of 0.0003. Well, the futures were lower than the spot as of today, and so on 12th of September they'll be lower than the spot. Subtract 0.0003 and you get 1.4799. I'm sorry, I know it takes a while to talk through it, partly because I made a silly mistake, but practice a few, it's actually very quick when you come down to it. However, now I can go back to where we were. We were showing what happened on the 12th of September. The transaction is converted at spot. The futures could be a gain or a loss depending on how the price has moved. But to calculate the gain or loss, we take the number of contracts. It was 5. Times the contract size, £62,500, times the difference between the sell and the buy rate. Now here, remember, we sold futures initially at the current rate, which was 4840. To finish the deal, we buy futures on the 12th of September, and we've just worked out a price of 1.4799. The difference between the two is the profit. So 1.4840 minus 1.4799 is a difference of $0.004 on every pound. Again, the futures prices are dollars per pound. The difference, the profit, is dollars. But apply that to 62,500, contract size 5 contracts, and I get a profit of 1281.25. It's a profit, it's a gain, because we sold at a price higher than we bought. So a gain of 1281. Finally, though, like last time, this is calculated in dollars, so we'll receive dollars. We're in the UK, so to convert to pounds, we'll convert at the 12th of September spot when we get the gain. So $12.81, we're selling dollars to buy pounds. The relevant rate on the 12th of September, 4812. So in pounds, the gain is 1281.25 minus 1.481. 1281.25 divided by 1.4812 gives me a gain of 865. It is a gain, so it's a receipt. And so the net payment, we pay out 338043, we receive 865, the gain on the futures, a net figure of 337178. Payment. Okay, we're nearly there. But I'm afraid there's going to be one last lecture to deal with the remaining things. One's a bit of terminology. You occasionally see ticks mentioned in the exam, but as explained in the next lecture, you never actually need to use ticks. I never do. But finally, and somewhat more importantly, what happens if, as in real life, not only do you not know the futures price on the date of the transaction, but of course when you start all this off, you don't know what the spot rate's going to be either. Well, I'll cover both those things in the next lecture, and then we've got it. Please keep the answer to this one handy, because I'm going to use some figures from here in just one bit of the next lecture. So one more lecture, then we've got it.